Chart Increasing Financial and Stock Exchange News Report, February 11, 2026. Disclaimer: this content is for informational purposes only. It is not legal, medical, financial, or official advice. Do not treat anecdotal stories, market movements, or commentary as guidance. Always consult a licensed professional before making financial decisions. Report Overview. 1. S&P 500 pulls back after multi-week rally. The S&P 500 slipped 0.6% as investors rotated out of megacap tech and into defensive sectors. Analysts cite valuation fatigue after a 14-day upward streak, the longest since 2021. Utilities and healthcare led gains, while semiconductors saw the sharpest declines. 2. Treasury yields spike on hot inflation revision. A revised CPI dataset showed core inflation running 0.2% hotter than previously reported. The 10-year Treasury yield jumped to 4.41%, pressuring rate-sensitive equities. Futures markets now price in one fewer rate cut for 2026. 3. Bitcoin ETF inflows hit $1.2 billion in 24 hours. Spot Bitcoin ETFs saw their largest single-day inflow since launch, led by BlackRock and Fidelity. BTC briefly touched $58,900 before retracing. Analysts attribute the surge to institutional rebalancing and sovereign wealth fund accumulation. 4. Disney surges on earnings beat. Disney stock climbed 7.4% after reporting stronger than expected streaming revenue and theme park attendance. The company announced a $3 billion share buyback and a new dividend increase. Analysts upgraded the stock, citing multi-segment momentum. 5. Tesla faces SEC inquiry over autopilot disclosures. The SEC opened a formal investigation into whether Tesla misrepresented autopilot safety data in investor communications. Shares fell 3.1% on the news. Tesla has not issued a public statement beyond confirming cooperation. 6. Viral financial product of the day, Fidelity Youth Debit Card. The Fidelity Youth Card trended on TikTok after a viral budgeting challenge. New sign UPS surged 240% week over week. Resale angle: limited edition card designs from 2022 are selling for $40 to $60 on collector marketplaces. 7. High value resale item: 2020 American Gold Eagle coins. Secondary market premiums jumped from 6% to 18% due to supply shortages. A sealed 20-coin tube now sells for $48,000 plus, up from $41,000 in December. Dealers report record low retail inventory. Financial and Stock Exchange News Daily, February 11, 2026. Global Markets and Crypto Update, Finance News spoken by AI. Market Overview: stocks pull back as yields spike. Wall Street retreats from highs. U.S. stock markets gave up early gains on Wednesday as investors reacted to robust economic data and rising bond yields. The S&P 500 initially climbed toward a record intraday level but pulled back in a volatile session. The benchmark index ultimately erased its gains and closed roughly flat, down about 0.06% at 6,937 points. The Dow Jones Industrial Average also reversed course, dipping 0.3%, almost equals 145 points, to around 50,043, while the tech-heavy Nasdaq ended essentially unchanged after earlier swings. Investors saw the early rally fade as they balanced encouraging economic signals with concerns about interest rates, resulting in notable market volatility. 2026. Barcart.com, Barcart.com. Strong jobs report: the catalyst for the market's volatility was a surprisingly strong January employment report. The U.S. added 130,000 jobs last month, far exceeding forecasts of 55 to 75K, and the unemployment rate ticked down to 4.3%. Initially, this financial news bolstered optimism about the economy's resilience. Stocks in economically sensitive sectors like energy and basic materials leapt on hopes of sustained growth. However, the robust labor data simultaneously raised fears that the Federal Reserve may delay potential interest rate cuts. Traders pushed out expectations for Fed easing, as the healthy jobs market suggested less need for immediate stimulus. Notably, the Labor Department's report also included revisions showing far fewer jobs were added in 2025 than previously reported, just 181,000 versus an earlier estimate of 584,000. While these revisions indicate the labor market wasn't as strong last year as believed, experts noted the downward adjustments were better than expected, suggesting a mild economic cooling rather than a sharp downturn. Barcart.com, Barcart.com, Barcart.com. Treasury yield spike. The bond market moves were swift in response to the data. The 10-year U.S. Treasury yield jumped initially, reflecting a Treasury yield spike as investors anticipated a more hawkish Fed stance. Yields held near their highest levels in months, hovering around 4.17% on Wednesday. This is close to the peak reached after the recent nomination of noted inflation hawk Kevin Warsh to head the Fed, an event that briefly pushed the 10-year yield up to 4.29% earlier in February. The latest yield increase, about 1 basis point on the day, reinforced the notion that rates may remain elevated longer in 2026. Higher bond yields can pressure equities by making borrowing more expensive and lifting returns on safer assets, which contributed to the stock pullback. Meanwhile, the 2-year Treasury yield, more sensitive to Fed policy, rose to roughly 3.51%, up from 3.45%, as traders recalibrated their interest rate outlook. Barcart.com, Royce.ai. Global markets mostly up. Major global markets outside the US were more upbeat. European stocks advanced broadly. For example, London's FTSE 100 gained about 1%, supported by optimism about the Eurozone economy and cooling inflation. In Asia, indices also closed higher. South Korea's Kospi rose 1%, and other regional markets followed suit on optimism that China's economic activity is stabilizing. However, U.S. investors remain focused on upcoming macroeconomic reports. Later this week, the government will release a fresh consumer price index report, which could show an inflation trend or inflation revision from prior data. These figures will be scrutinized for clues on the Fed's next steps, as persistent inflation above the 2% target would bolster the case for keeping interest rates elevated. Barcart.com. Key market indicators. Below is a snapshot of major market indexes and asset prices as of February 11, 2026, including their daily and week-to-date changes. Market index/asset. Current value. Daily change. Weekly change versus last week. S&P 500. 6,937. Minus 0.06%. Plus 0.6%. Dow Jones Industrial Average. 50,050. Minus 0.3%. 0%. Nasdaq Composite. 23,050. Plus or minus 0.0%. Plus 0.2%. 10-year U.S. Treasury yield. 4.17%. Plus 0.011 BP. Minus 0.077 BPS. Bitcoin, BTC USD. $70,000. Plus 2.0%. Minus 4%. Gold, spot dollar/Oz. $5,080. Plus 0.2%. Plus 2.3%. Data sources, Reuters, AP, CNBC, coin exchanges, reflecting approximate market levels on February 11, 2026. Daily changes are from the prior trading session, weekly changes are measured relative to 1 week ago. Crypto market news, Bitcoin ETF inflows and volatility. Bitcoin ETF inflows hit record. In crypto market news, an encouraging sign emerged for Bitcoin amid what has been a turbulent start to 2026. Spot Bitcoin ETFs have seen a record inflow of institutional cash in recent sessions. After roughly 3 weeks of steady outflows, investors poured about $562 million into Bitcoin-focused exchange-traded funds on Monday alone, halting a prolonged bleeding streak in crypto funds. This wave of Bitcoin ETF inflows, the largest single-day influx so far this year, follows a smaller $371 million burst of inflows last Friday. The rapid turnaround suggests that big players are buying the dip after Bitcoin's recent correction. Analysts note that such ETF inflows often signal returning institutional demand, which could help establish a price floor for Bitcoin despite recent volatility. Cointribune.com, INVZZ.com, Finance.yahoo.com, THUtradable.com. Bitcoin price rebound attempts. The price of Bitcoin itself has been volatile but is off recent lows. After plunging below $60,000 in a sharp January sell-off, Bitcoin rebounded and has been trading in a range of roughly $68,000 to $72,000 in recent days. As of today, BTC is hovering near $70,000, up a few percent from yesterday's levels.
Go read some of my comments.
Still, on a weekly basis, Bitcoin remains down about 4 to 5%, reflecting lingering caution after its multi-month decline. Industry observers highlight that unlike earlier crypto downturns, the recent pullback lacks signs of systemic distress, no major exchange failures or debt liquidations, indicating the weakness may be driven more by shifting sentiment and macro factors than fundamental issues.
He ends up cheating.
INVZZ.com, finance.yahoo.com,
what is going on, guys? It is Taylor the Fiend back again.
Crypto market
and today
context.
We are taking a
the
look at
resurgence
modern
of
women
interest via
proving why
ETFs is a
men
positive
don't want to
indicator
date
for the
them.
broader
Let's jump
crypto
into
market.
it.
One of the most dumb
It comes after U.S. regulators finally approved spot Bitcoin ETFs, including products by BlackRock and others, in late 2025, a watershed that opened the door for more traditional investors to gain Bitcoin exposure. These inflows suggest institutions see value at current prices. Nevertheless, experts caution that the market remains sensitive to macroeconomic conditions, such as U.S. interest rates and liquidity, which have a significant impact on digital asset prices.
What makes you think?
Many crypto analysts are looking ahead to the Federal Reserve's policy signals and the upcoming inflation report. Any indication of tighter financial conditions could introduce renewed volatility.
They say that real men
on
pay
the
for dates
upside,
and
some
nothing
analysts,
less will
like those
suffice.
at Bernstein,
They've literally
maintain
admitted
a
this on
bullish
camera
long-term
for the
outlook,
last
still
15 plus
forecasting
years.
Bitcoin could reach six-figure prices, e.g. $150,000, by the end of 2026 if the current consolidation resolves and macro conditions improve.
That's a different story, but don't try and blame it on us. Don't try and make it seem like it's our fault and that we're just using you guys. Come on.
Corporate
Who
earnings,
wants to spend
Disney's big beat.
1+ hours with
Disney's
somebody
earnings
that
beat
they don't like and
expectations.
that they don't
In Corporate
find
Financial
interesting
Analysis
to talk
Daily,
to
the Walt
for a
Disney
free
Company
meal?
delivered an impressive
Why would
earnings
I
beat
go
that
out
has
with
bolstered
somebody
market
that I'm not
confidence in its
potentially interested
turnaround
in,
plan?
spend over an hour
Reporting
and a half
results
with them
for its
at a
fiscal first
restaurant
quarter
I
of
go to
2026,
without them
covering
on a
Q4
regular basis.
2025, Disney announced revenue of $25.98 billion,
Just admit you can't
up
afford it
5%
and
year-on-year,
Maybe you're
and adjusted
projecting
earnings of $1.63
This isn't
per
the
share.
1800s anymore. Like women
These
can actually
figures surpassed
afford.
Wall Street's estimates of
Women can afford things 'cause we have our own
$25.74 billion
jobs.
in
It's just
revenue
such a
and
slap in the face that you guys
$1.57
think we can't
EPS.
afford this dinner and
The
we
strong
need you
results
to
were
pay for
propelled
it.
by
It's
record
not that men
performance
are
in
broke.
Disney's theme
Men are
parks and
tired of being
experiences
used,
division,
not to mention
which for the first
constantly
time ever
insulted. And
generated
the only
over
reason
$10
that men are
billion
getting
in
insulted
quarterly
is because
revenue.
these women are getting bent out of
Domestic
shape for
park
being called
revenues
out.
jumped
They
7%
said it.
to
We are just
$6.9
reminding
billion,
There's going to be nothing
reflecting
like
higher
the female
attendance and
loneliness
spending,
epidemic
while
that you're going to
international
see
parks
with this
also grew
generation of
despite some
women when they
softness
hit the
in
40s.
overseas
It's going to be out of
visitation.
control.
Many years from now, there is going to be a quiet
Streaming and
crisis.
Outlook. Disney's streaming
Loneliness
business
in
also
women,
showed promising
especially.
signs on its
Not
path
because
to
women failed,
profitability.
not because they weren't capable
Losses
or
in the
intelligent,
Disney
but
Plus streaming
because they
unit
were
narrowed
handed a
significantly,
script or a
and the company
blueprint that
projected
left
that
out
its
the
streaming
consequences.
segment would achieve
Be
around $500
self-sufficient,
million
put your
in
career
operating
first.
income
You
in
don't
the
need a
current
man.
quarter,
So
a
they
notable
followed
improvement
it. They
over
pushed
last
love
year.
down the line.
This
They delayed
progress
the
comes
family.
after
They
strategic
treated
cost-cutting
commitment
and
like
price
something
hikes in
that could always
2025
wait
helped
until
reduce
it
streaming
didn't.
losses.
This is not a quiet
CEO Bob
crisis. There
Iger,
is nothing
who returned
quiet
to lead
about
Disney
it.
in
Modern women go into
2022,
the front seats of
expressed
their
confidence
cars
that
and
the
keep
company's
crying that
hard
they
work
can't
and
find a
strategic
man, can't get a
investments are
date,
paying
and
off,
cry
setting
as they
Disney
ask
on the
where
path
are
to
the good men
continued
at.
growth.
At this point, it's only going
He
to get
highlighted
louder.
double-digit
Fast forward,
percentage
few
growth in
years
adjusted
later.
earnings
You're
expected
older,
for fiscal
no partner,
2026
no
and plans
children,
to resume
no
share
legacy,
buybacks,
just
with a
some
$7
noise
billion
to fill that
repurchase
silence.
authorization
There's going to
as
be
signs of
nothing
financial
like the
strength.
female loneliness epidemic that you're going to see with this
CNBC.com.
generation of women when they hit the
Investor
40s.
reaction
It's
and
going to
next
be out of
steps.
control.
Despite the
When
earnings
these
beat, Disney
20-somethings
stock saw a
hit
mixed reaction.
40-something, there's going to be
Shares
massive
initially popped in
devastation.
after
There's
hours,
going to be
trading
the
on the
pharmaceutical
strong
companies
results,
are
but
going to be
later
like,
dipped around 7%
cashing
the
in
next day,
on the
as investors weighed
antidepressants and all of
longer-term
that if they go
questions.
that route.
It's already
One
happening
overhang
right
is
now.
Disney's
If you take a
leadership
look at the
succession
numbers
plan.
of modern
The board
women
has been
on some
meeting
kind
this
of
week to select a new
antipsychotic
CEO
medication,
to
the
eventually
numbers are
take over
far
for
too damn
Iger,
high.
with a
A lot of
decision
modern women
expected
are
soon.
miserable, they're lonely, and
The
they can't
uncertainty around
understand that their
Iger's
behavior
successor
is
and the
what brought them
company's
to this
future
point.
strategy might have
Women
tempered
nowadays
some
love to
enthusiasm
say
in the
that their
stock.
husband is controlling. Meanwhile,
Nonetheless, analysts
direction.
largely viewed the
It's the
quarter as a
protection that you
positive step.
wanted. If your
Disney's
husband is telling
ability
you,
to
you know
boost
what? I'm not a
profitability
fan
by
of that friend I
turbocharging
feel like
parks
she
and
has a bad
improving streaming
influence on
margins
you.
is seen as strengthening the hand of
That
whoever
outfit
becomes
draws
the next
unwanted
chief
attention
executive.
that I'm not comfortable with, or
The company's
you
results
following that
underscore that
person
its
or
iconic
engaging
brand
someone
and
on social media
diversified
makes me
entertainment
uncomfortable.
portfolio continue
I'll
to
tell you what,
yield
if I had a
robust cash
strong
flows, even amid industry challenges.
Me and he told me something made him uncomfortable. He didn't like it. Okay,
Regulatory
bye, done,
spotlight.
done.
Tesla's
crazy
SEC
how modern women
investigation. SEC case pressures Tesla. high-flying electric automaker Tesla is contending with an ongoing regulatory cloud. The company's CEO, Elon Musk, remains under the shadow of a Securities and Exchange Commission (SEC) investigation, a development that has drawn attention on Wall Street and in Washington. Tesla's SEC investigation. The scrutiny stems from Musk's past actions related to Twitter. Now X. The SEC has alleged that Musk failed to properly disclose his accumulation of a significant Twitter stock stake in early 2022 within the required timeframe. This month, a federal judge rejected Musk's attempt to dismiss the SEC's lawsuit, allowing the case to proceed and keeping the investigation in the headlines. The SEC contends that Musk's 11-day delay in reporting when he crossed a 5% ownership threshold in Twitter shares allowed him to purchase additional stock at lower prices, allegedly netting $150 million in gains once the news finally became public.
A giant banana cake
LaTimes.net.
made with actual banana
Context and
cake
impact.
layers.
Musk has labeled the SEC's actions as an overreach, arguing that his
you guys
delayed
know that
filing was
realistic cakes are
inadvertent and
not
that the
my strong
agency is
suit, so I
unfairly
tried to
targeting
convince him
him
to
for
do
his
something else, but he
outspoken criticism of
carving the cake
regulators.
and covering it with ganache. That was all
However,
going
the
well
case is
until I
set to
had to cover it
continue,
with fondant.
with the
And as
SEC
you can see,
seeking
I'm
to force
really out
Musk
of
to
my
disgorge
element
the
here. I really
$150
struggled
million
getting those
in
smooth,
alleged
crisp
gains and
sides.
potentially pay
I did
additional
almost cry
penalties.
at one point, but
While
anyway,
this
I ended
particular
up
legal
just
battle
putting some
revolves around
sprinkles,
Musk's
some
personal
banana
conduct
sprinkles
prior
around
to
the sides,
acquiring
and
Twitter,
then the
which he
characters made
purchased
it
for
look cute.
$44
I also made
billion
these
in
adorable
late
minion
2022.
cupcakes. In
It
the
adds
end,
to
I
the
think
list of
everything came out
regulatory
really
issues
cute,
orbiting
even though it's
Tesla's
not
CEO.
perfect, and my little buddy was
Investors
so
are closely
happy.
monitoring these developments for any signs of distraction or impact on Tesla's leadership. So far, Tesla's core business remains strong. The stock recently touched new highs, buoyed by robust car delivery numbers and optimism around forthcoming product launches, but the SEC probe is a reminder of the risks that high-profile CEOs can sometimes pose to their company's stability. LaTimes.net. Other regulatory news. In broader finance news, U.S. regulators and lawmakers continue to keep a close eye on corporate governance and market integrity. For instance, separate from the Musk case, there have been calls for greater scrutiny of corporate boards and insiders to ensure timely disclosure of significant holdings and to prevent market manipulation. Meanwhile, rising interest rates have also drawn attention to bank capital requirements and bond market liquidity. Rising interest rates have also drawn attention to bank capital directly impacting Tesla. They contribute to a climate of more assertive financial regulation in 2026. Investors appear to be factoring in a degree of regulatory risk across tech and finance sectors, which could be one factor in the recent market volatility. 2026 viral financial products. Investing in gold coins resale 2026. Beyond the stock and corporate news, a pair of personal finance trends have gone viral and are capturing public interest in early 2026. Viral finance trends have gone viral. Fidelity's youth account and debit card. Fidelity Investments' new youth account, essentially a teen-focused brokerage account with a debit card, is gaining significant traction among young investors and their parents. This product, often dubbed the Fidelity Youth Card, allows teenagers aged 13 to 17 to invest in stocks and ETFs, with parental oversight, and even comes with a no-fee debit card for spending their account funds. The initiative, which first launched in 2022, has seen a surge in popularity through late 2025 and into 2026 as part of a broader push toward financial literacy for Generation Z. Social media buzz and positive reviews highlight how the Fidelity Youth Account empowers teens to learn investing by doing. In a controlled environment, parents can monitor activity and set limits. The account charges no fees or commissions, and teens can start investing with as little as $1, making it an accessible way for young people to enter the market. Fidelity has even rolled out educational content and thematic youth investment baskets tailored to Gen Z interests, like tech, gaming, and entertainment stocks, to engage these new investors. This trend reflects a growing demand for financial products that cater to digital native teenagers, and other brokers and fintech firms are now exploring similar offerings. Fidelity.com, 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 BusinessInsider.com, BusinessInsider.com. American Gold Eagle resale boom. A fascinating trend is unfolding in the precious metals market, a resale boom for American Gold Eagle coins. These popular U.S. mint-issued gold coins, often seen as a barometer of retail investor sentiment in gold, are changing hands at unprecedented volumes on secondary markets. Several factors are fueling this Gold Eagle resale frenzy. First, the price of gold itself has surged to historic highs in recent months, recently breaching the $5,000 per ounce milestone and even briefly trading above $5,300 before a bout of profit-taking. This gold rally, driven by expectations of future Federal Reserve rate cuts, geopolitical uncertainties, and strong demand from central banks, has dramatically increased the value of gold holdings. As a result, many retail investors are choosing to cash in by selling gold coins acquired in past years at much lower prices. Coin dealers report that American Gold Eagle buyback volumes are up sharply, with some offering notable premiums for certain editions of the coin due to tight supply. Additionally, 2026 marks the 40th anniversary of the Gold Eagle program, which is generating numismatic interest and boosting demand for both new and older coins. Collectors and investors are keen to capitalize on the high gold prices and the anniversary hype, creating a vibrant seller's market for these coins. Financial advisors caution, however, that gold prices can be volatile. Just in the past week, gold pulled back a few percent from its peak, reminding investors that even safe haven assets can experience swift price swings. 247wallstreet.com, invzz.com, 247wallstreet.com, 247wallstreet.com, cointribune.com. Video script, Financial and Stock Exchange News Daily, February 11, 2026. Hello and welcome to Financial and Stock Exchange News Daily, your Wall Street report on global markets and finance spoken by AI. I'm your AI host, and I'll be guiding you through today's top financial news stories. It's February 11, 2026, and here are the major headlines. Asterisk markets pull back as data surprises. U.S. stocks are down slightly after touching record highs earlier. The S&P 500 is pulling back as of today. The SP 500 today, it's essentially flat after a strong start fizzled out. The Dow Jones is off about 0.25%, and the Nasdaq is little changed. Why? A strong jobs report gave investors mixed feelings. Good news for the economy, but it could mean interest rates stay high longer. That uncertainty sparked some profit-taking and market volatility 2026 on Wall Street. Barcart.com. Treasury yield spike in focus. There's a lot of talk about bond market moves, as Treasury yields spiked on the jobs news. The 10-year Treasury yield jumped to around 4.2%, one of its highest levels in over a year. Higher yields have been putting pressure on stocks by raising borrowing costs and offering investors an attractive alternative to equities. With an inflation update due soon, traders are keeping a close eye on interest rates and any inflation revision that could sway Federal Reserve policy. Royce.ai. Asterisk record Bitcoin ETF inflows. Turning to crypto market news, we're seeing signs of life in the cryptocurrency market. Bitcoin ETFs just hit record inflows. Over $500 million flowed into U.S. Bitcoin exchange-traded funds in just a few days. This flood of money is a big reversal after weeks of heavy outflows, suggesting that institutional investors are buying the dip. Bitcoin's price is currently around $70,000, rebounding from recent lows. However, it's still below its peak from late last year, so analysts warn that volatility isn't over yet. Still, these Bitcoin ETF inflows are a positive sign that big investors have regained some confidence in crypto. Cointribune.com, invzz.com. Asterisk Disney's earnings beat expectations. In corporate news, Disney delivered a Magic Kingdom-worthy performance. The entertainment giant reported higher than expected earnings and revenue for last quarter. Profits were boosted by booming theme park business. Domestic parks pulled in a record $6.9 billion in revenue, and its streaming services moving closer to profitability. This Disney earnings beat shows that CEO Bob Iger's turnaround plan, focusing on theme parks and streaming, is bearing fruit. The stock market reaction was mixed, though, as investors are also watching for Disney's next CEO pick, with Iger set to step down in the future. Overall, this Financial Analysis Daily headline shows Disney's core businesses are strong even as it navigates leadership changes. CNBC.com. Asterisk Tesla under SEC investigation. Electric vehicle leader Tesla and CEO Elon Musk are back in the regulatory spotlight. Musk is fighting an SEC lawsuit alleging he violated securities laws by not promptly disclosing his big purchase of Twitter stock in 2022. A judge just refused Musk's request to throw out the case, so the Tesla SEC investigation continues. The SEC claims Musk's delay in reporting his Twitter stake let him unfairly profit by about $150 million. Musk calls the case government overreach, but it's not going away. While Tesla's car business has been performing well, its stock recently hit new highs. this legal cloud is a reminder that Musk's actions can create extra risk for the company. Traders will be watching how this saga unfolds, though so far Tesla's share price has largely shrugged it off amid strong sales figures. MoneyLATimes.net. Asterisk trending, teen investing in gold coin resales. Two trending financial stories are making waves on social media. First, the Fidelity Youth account, essentially a debit card and investing account for teens, is surging in popularity. Viral finance products. This finance spoken by AI segment highlights how big firms are courting Gen Z. The Fidelity Youth account lets kids 13 to 17 invest in stocks and ETFs with parental guidance, and it's being praised for promoting financial literacy among young investors. Second, there's a resale boom for American Gold Eagle coins. With gold prices above $5,000 per oz near all-time highs, many investors are cashing in their gold coins for hefty profits, driving up demand in secondary markets. Coin dealers report that certain Gold Eagle coins are selling at record premiums. It's a reminder that tangible assets like gold can generate buzz when prices skyrocket, but also that even safe haven assets can swing in value. Gold pulled back a bit from its peak this week. Fidelity.com, 247wallst.com, INVZZ.com, Cointribune.com. That's all for today's Financial and Stock Exchange News Daily Update. Thank you for listening to our Stock Exchange Daily Briefing. Disclaimer: this content is for informational purposes only and does not constitute financial or investment advice. Always do your own research or consult a professional before making financial decisions. Stay informed, stay safe, and we'll see you next time. Tags: Financial News, Stock Market Update, SP 500 Today, Treasury Yield Spike, Bitcoin ETF Inflows, Crypto Market News, Disney Earnings Beat, Tesla's C Investigation, Market Volatility 2026, Finance Spoken by AI, Stock Exchange Daily, Wall Street Report, Inflation Revision, Bond Market Moves, Viral Finance Products, Gold Eagle Resale, Financial Analysis Daily. Sources: Formatting data. Label SEO optimized tags, copy/paste ready. Financial News, Stock Market Update, SP 500 Today, Treasury Yield Spike, Bitcoin ETF Inflows, Crypto Market News, Disney Earnings Beat, Tesla's C Investigation, Market Volatility 2026, Finance Spoken by AI, Stock Exchange Daily, Wall Street Report, Inflation Revision, Bond Market Moves, Viral Finance Products, Gold Eagle Resale, Financial Analysis Daily. Scroll video description, SEO rich plus disclaimer. Financial and Stock Exchange News Daily spoken by AI delivers fast, reliable updates on global markets, equities, crypto, and macroeconomic trends. Today's report covers the S&P 500 pullback, Treasury yield spike, record Bitcoin ETF inflows, Disney's earnings surge, Tesla's SEC inquiry, and two trending items, the Fidelity Youth Card and American Gold Eagle resale boom. Disclaimer: this content is for informational purposes only and is not legal, medical, financial, or official advice. Do not treat anecdotal stories or commentary as guidance. Chart increasing financial and stock exchange news ultra deep dive script. February 12, 2026. Broadcast/YouTube/podcast script formatting, expanded analysis for every topic. Source note: your February 12 headlines are treated as the show rundown. Where I reference independent context, I'm drawing from public sources and your prior internal draft file to explain mechanisms and implications. Some of today's exact point-in-time price/percent figures in your rundown could not be independently verified in the sources retrieved, so I clearly label those as per your report. Cold open, midnight to 0:25. Anchor, energetic, crisp. Welcome to Financial and Stock Exchange News, Deep Dive Edition. Today, we're going beyond the headlines: sector rotation inside equities, the Fed's no-rush stance, Bitcoin's ETF-driven microstructure, Disney's earnings plus buyback catalyst, Tesla's regulatory overhang, and two fast-moving consumer/resale trend stories that show how scarcity and attention can reprice value overnight. Anchor, quick legal read. This content is informational only, not financial advice. Segment 1: S&P 500 edges higher/rotation into industrials, 0:25 to 5:30. Anchor. Per your report, the S&P 500 rose 0.4% as investors rotated out of megacap tech and into industrials and energy. Today's key word is rotation, because rotation is what markets do when the narrative changes faster than the index level does. Voiceover explainer, slow, clear. Rotation is essentially portfolio surgery. Managers don't always sell the market. They sell parts of it, especially crowded winners, and redeploy into areas that either 1. Haven't moved yet. 2. Benefit from a different macro setup, or 3. Provide better valuation or earnings leverage. Deep context: what rotation usually signals? A shift toward industrials often implies markets are leaning into expectations for real economy throughput, manufacturing activity, capex cycles, logistics, construction, and infrastructure. Schwab's early February sector view had industrials rated outperform in its 6 to 12-month framework, reinforcing that this sector was already on many allocators' leadership watchlist. Schwab.com. At the same time, big-picture strategists have warned that concentration risk and high valuations can increase the odds that leadership broadens beyond megacap tech. Goldman Sachs highlighted elevated index concentration and valuation sensitivity in 2026, a setup where rotation can happen even without a crash. GoldmanSachs.com. Anchor adds nuance. Now, one important point: rotation can happen in two different moods. Risk-on rotation: money moves from defensive assets into cyclicals because growth is improving. Risk management rotation: money trims crowded growth exposures because yields rise or volatility returns, and reallocates to sectors with nearer-term cash flows. A public market wrap I found described the day as sector leadership in energy/materials/staples with pressure on tech as yields climbed, underscoring that rotation can be driven by rate expectations even if the tape looks calm. Monexa.ai. Semiconductors: why mild weakness matters even when it's not dramatic. Per your report, semis softened after a multi-week rally. That's often a classic positioning and sensitivity story. Semis can behave like a leveraged bet on both growth expectations and discount rates. When yields firm, markets tend to compress multiples on high-duration growth assets first, even if fundamentals haven't changed. What to watch? Non-advice, just the map. If rotation persists, you typically see improving market breadth, more stocks participating. Watch whether cyclicals lead without the index needing megacap tech to pull it upward. Watch whether industrials/energy strength is confirmed by earnings guidance language, capex, backlog, orders. Show continuity: your internal content tie-in. Notably, your internal February 11th draft also emphasized rotation away from megacap tech, though into defensives that day, showing how leadership can rotate again within 24 hours as new macro inputs land. Chart Increasing Financial and Stock Exchange News Report, February 11. Docs, Chart Increasing Financy, February 11. A word. Segment 2: Fed signals no rush on rate cuts, 5:30 to 11 o'clock. Anchor. Per your report, a senior Fed governor said the Fed is not in a hurry to cut rates, pushing expectations toward late summer and nudging the 10-year yield higher. You cited 4.39%. Important verification note: transparent. I did not retrieve a public source that specifically confirms your exact late summer repricing and the 10-year close at 4.39% for today, so treat those as your rundown numbers. What I can ground is the broader policy posture and the why it moves markets mechanics. Macro context: grounded. A late January 2026 bank rate summary reported the Fed held rates steady at its first meeting of the year, keeping the benchmark range at 3.5% to 3.75%, and framed policymakers as wanting more convincing evidence on inflation/labor before resuming cuts. And the Fed's official calendar confirms the 2026 meeting schedule and cadence, which matters because late summer expectations map onto specific meeting windows. Bankrate.com, FederalReserve.gov. Deep dive: what no rush really signals. When a Fed official says no rush, markets typically translate that into three pricing consequences. 1. Front-end repricing: 2-year yields react more than 10-year. The market reduces probability of near-term cuts, lifting short yields. 2. Term premium/long-end drift. If growth remains resilient, longer yields can rise as investors demand more compensation for duration risk. 3. Equity valuation pressure at the margin. Higher discount rates compress valuations for long-duration equities, often high multiple growth in parts of tech, which can accelerate, you guessed it, sector rotation. Anchor connects dots. So if stocks were rotating out of megacap tech today, no rush. Fed language is a plausible accelerant, not because tech is bad, but because relative valuation becomes harder to justify when rates are sticky. What to watch? Watch how the market interprets upcoming data prints relative to the Fed's dual mandate. Watch for cut timing to concentrate around specific FOMC meetings on the calendar. FederalReserve.gov. Watch whether the yield move is orderly or volatility-driven. Volatility tends to spill into equities faster. Segment 3 Bitcoin briefly breaks $59,000 then pullback, 11 to 1700 hours. Anchor. Per your report, Bitcoin surged to $59,200 before retracing on profit-taking, with spot Bitcoin ETFs still seeing inflows, though slower than earlier in the week. Verification note. The public sources retrieved in this run did not confirm the exact $59,200 print for today. What I can ground is the broader early February context. CNBC described Bitcoin selling off sharply in February 2026, emphasizing that crypto remains highly volatile and subject to rapid risk-on/risk-off shifts. CNBC.com. Deep dive: why ETFs matter for intraday Bitcoin moves. Spot ETFs change Bitcoin's market microstructure by introducing creation/redemption flows that can force real spot buying/selling. More traditional portfolio rebalancing behavior, month/quarter positioning. A tighter relationship between Bitcoin and broader financial conditions. So when your report says inflows continued but slowed, that's a demand still there, but urgency fading signal, which often produces exactly the pattern you described, push higher profit-taking retrace. Profit-taking mechanics, clear, non-technical explanation. Profit-taking isn't a fundamental thesis shift. It's a position management decision. Traders who bought earlier take gains into strength. That selling can trigger stop orders and short-term momentum flips. In crypto, thinner liquidity at certain levels can exaggerate the move. Regulatory clarity angle, how it influences pricing. Your rundown cites anticipation of upcoming regulatory clarity. In crypto, expectation can move price even before policy arrives. That creates a buy the rumor, sell the news risk where volatility spikes when actual details disappoint someone's positioning. What to watch? ETF flow trend direction, steady inflows versus swingy days. Volatility regime, does Bitcoin move like a macro risk asset, rate sensitive, or does it decouple? Whether rallies are broad, alts participate, or narrow, Bitcoin only, narrow rallies are often more fragile. Segment 4 Disney jumps on streaming subscriber beat plus $3 billion buyback, 1,700 hours to 2,400 hours. Anchor. Per your report, Disney rose 5.1% after stronger than expected streaming subscriber growth and announced a $3 billion share buyback. Your report also cites upgrades tied to improved margins and theme park performance. Verification note. The web sources retrieved here did not confirm today's exact move or the specific report. However, multiple sources established the strategic importance of Disney's streaming profitability trajectory and buyback signaling as market catalysts in recent years. For example, Investopedia reported Disney outlining $3 billion in stock buybacks and emphasized the market's focus on streaming operating performance and outlook language. Additionally, Liontree's early February 2026 weekly commentary flagged Disney as a key earnings narrative item in the TMT/consumer landscape, highlighting how investors were actively framing Disney within broader sector themes. Investopedia.com, Liontree.com. Deep dive: why subscriber beats can move the stock even in profit-first markets. Streaming is a scale business. Subscriber growth matters because it affects revenue base, obvious. Churn dynamics, stickiness. Content amortization efficiency, cost spread over more users. Pricing power, ability to raise ARPU without losing subs. But markets don't reward subs blindly anymore. The higher quality beat is subs up and margins improving and management confidence increases, guidance, buybacks. The buyback signal, what $3 billion communicates. A buyback announcement typically communicates two things. 1. Management believes the stock is an attractive use of capital relative to alternatives. 2. The company has confidence in cash flow durability. Even if the buyback isn't immediately massive relative to market cap, it changes the narrative, from turnaround in investment cycle to stabilization and return of capital. Theme parks, why they matter in the Disney equation. Theme parks are often Disney's cash flow engine. When parks are strong, they can subsidize streaming investment or accelerate deleveraging. That's why analysts frequently cite parks' resilience when they upgrade the equity. It's the ballast under the higher volatility streaming segment. What to watch? Streaming margin trajectory, not just subs. Price increases versus churn. Segment mix, experiences versus media. Capital allocation, does Disney keep returning cash or reinvest aggressively? Segment 5, Tesla regulatory inquiry over autopilot data, 24:00, 33:00. Anchor. Per your report, Tesla confirmed cooperation with a new federal inquiry into autopilot safety disclosures, and shares dipped 2.4%. Grounded context, the regulatory backdrop is real and ongoing. Federal scrutiny of Tesla's autopilot and related driver assistance systems has been extensive. In prior investigations, regulators have tied autopilot to a large number of collisions and highlighted concerns around driver attention safeguards. NBC News summarized NHTSA findings describing a critical safety gap linked to hundreds of collisions and noted additional probing of Tesla's recall/software remedy adequacy. Consumer Reports likewise described NHTSA opening a new investigation into the adequacy of Tesla's autopilot recall fix and argued that warning/control changes may not sufficiently prevent misuse. NBCnews.com, ConsumerReports.org. Deep dive: why disclosure investigations hit the stock differently than defect investigations. There are two distinct risk categories. 1. Engineering/safety risk. Could lead to recalls, software constraints, reputational damage, and product demand effects. 2. Disclosure/communication risk. If regulators examine whether internal testing data was represented accurately to investors, as your rundown states, the market often prices a different risk. Legal costs. Settlement uncertainty. Management distraction. And narrative damage to autonomy timelines, which are heavily tied to valuation expectations. Market mechanics: why shares dip even with cooperating language. Cooperating is neutral corporate language. Investors still price. Uncertainty on scope. Uncertainty on timeline. And uncertainty on outcome. What to watch? Whether inquiry expands to broader ADAS marketing claims industry-wide, this has precedent in how regulators gather data across manufacturers. Autosafety.org. Any changes to software constraints, monitoring requirements, or labeling language. How Tesla frames autonomy milestones in future investor communications. Segment 6, Viral Financial Product, BudgetBeam Smart Ledger, 33:00, 39:00. Anchor. Your report describes a compact digital budgeting device, BudgetBeam Smart Ledger, retail $39, resale $85 to $110, driven by scarcity and influencer demand. Verification note: important and transparent. I was able to verify the existence of BudgetBeam as a budgeting brand/product presence online, including a website and an app store listing, but I did not find independent evidence in the retrieved sources that it is a physical compact hardware device with the exact retail/resale pricing you listed. The BudgetBeam website describes an online budgeting platform. And the app store listing describes a budgeting mobile app, not a standalone device. Budget-beam.net, apps.apple.com. Deep dive: the economics of viral finance products, why resale spikes happen. Even without device verification, the pattern you're describing is a known mechanism. 1. Attention shock: a creator demonstrates an emotionally satisfying feature, real-time alerts. 2. Perceived utility plus novelty: consumers anchor value to the outcome, it stops overspending, not the BOM cost. 3. Supply constraint: limited inventory or distribution friction becomes the story. 4. Secondary market repricing: resale becomes a proxy for demand intensity. RALTIME alerts: why that feature goes viral. Budgeting is usually delayed feedback. Real-time alerts create immediate reinforcement, which feels like control, and tends to spread well on social platforms. What to watch? If the product is real hardware, restock timing will typically collapse resale premiums. If it's primarily an app, virality often drives subscription conversion instead of resale pricing. Segment 7 HAGH Value Resale, 2020 American Silver Eagle Proof Set, 39:0047:00. Anchor. Per your report, the 2020 Silver Eagle Proof Set resale surged, original $73, current $320 to $380, driven by collectors and low surviving mint condition. Grounded pricing context. Public coin pricing aggregators show ranges consistent with your stated resale band for certain 2020 Silver Eagle items/grades. Price charting displays values in the low to high $300s for 2020 American Silver Eagle entries in certain conditions, including figures around $320.70 and $388 in the snippet. USA CoinBook also provides coin-specific pricing context in notes proof variety values, example shown for 2020 as proof, illustrating how mint mark, grade, and variety can materially change market value. pricetching.com, usacoinbook.com. Deep dive, why proof set resale can gap up. Coin resale spikes often come from a combination of 1. Mintage/availability perception. Even if total production wasn't tiny, the number of sets staying in pristine condition can be limited over time, especially if packaging/COA matters to collectors. 2. Grade scarcity. A move from raw to graded markets can reprice items sharply because top grades trade with scarcity premiums. 3. Narrative catalysts. Anniversary editions, design transitions, or key year collector narratives can bring new demand. 4. Macro overlay. When macro uncertainty rises, collectible precious metal items sometimes see increased attention, blending collectible and store-of-value psychology. Important clarity. Low surviving mint condition is plausible as a driver, but exact survival counts are typically not measurable without population reports and dealer data. The sources retrieved here do not provide a precise survival statistic, only market pricing context. usacoinbook.com, pricetching.com. What to watch? Price dispersion between raw versus graded. Which mint marks/varieties lead the premium? Liquidity, are there many completed sales or just a few listings? Fire close, 47:0048:30. Anchor, wrap. Today's deep dive story is how narratives reprice risk. No rush-fed language can accelerate equity rotation. Bankrate.com, Schwab.com. Bitcoin's ETF era changes the flow mechanics behind sharp moves. CNBC.com. Disney's mix of streaming momentum and buyback signaling can flip sentiment quickly. Investopedia.com, Liontree.com. Tesla's regulatory/disclosure overhang remains a valuation-sensitive risk channel. NBCnews.com, ConsumerReports.org. Viral product and resale markets demonstrate that scarcity plus attention can create temporary price discovery events. Budget-beam.net, pricetching.com. Anchor, final disclaimer. Informational only, not financial advice. Optional production ADDONS included, no questions. B-roll suggestions per segment. Segment 1, Sector Heat Maps, Equal Weight versus Cap Weight Chart, Industrial/Energy Icons. Segment 2, Yield Curve Animation, Fed Calendar Graphic, FederalReserve.gov. Segment 3, ETF Flow Bars plus BTC Intraday Candle. Segment 4, Disney Plus Subscriber Graphic, Buyback Headline Overlay, Investopedia.com. Segment 5, Timeline of NHTSA Actions, Driver Monitoring Graphic, NBCnews.com, ConsumerReports.org. Segment 6 to 7, Resale Listing Blur Montage plus Attention Scarcity Premium Explainer. If you want, I can also convert this into 1. A tighter 8 to 10 minute script, 2. A 60 to 90 second shorts version, and 3. Teleprompter pacing with breath marks while keeping your disclaimer and tone consistent. Sources: Calendar Finance Sector Hybrid Report, February 14, 2026. Warning disclaimer, place at top of video and description. This report is not legal, financial, medical, or official advice. All content is news, analysis, and commentary only. Do not treat any anecdotal stories, market movements, or sector discussions as personalized advice. Always consult licensed professionals for decisions involving finance, law, or health. Keycap 10 major topics, 3 paragraphs each, 5 to 7 sentences per paragraph. 1. Market sentiment. Cautious optimism meets volatility. Paragraph 1. Market sentiment on February 14, 2026 reflects a blend of caution and selective optimism, driven by uneven momentum across growth and technology sectors. Short bursts of buying activity have been counterbalanced by hesitation in cyclical stocks, suggesting investors are still processing macroeconomic signals. The environment favors measured positioning rather than aggressive risk-taking, especially as traders digest inflation data and earnings updates. This dynamic has created a landscape where intraday swings are common, but conviction remains limited. Investors appear more focused on studying sentiment shifts than executing large directional bets. Paragraph 2. The broader market's behavior aligns with a pattern of recalibration following January's inflation report, which came in slightly lighter than expected. Despite the softer inflation reading, major indices failed to rally meaningfully, signaling that investors may be waiting for clearer confirmation of policy direction. The S&P 500 closed nearly flat, while the Nasdaq dipped, reflecting tech sensitivity to rate expectations. This muted reaction underscores how markets are increasingly data-dependent and less reactive to single-point surprises. The Dow's modest gain further illustrates the fragmented sentiment across sectors. Paragraph 3. Underlying this cautious tone is a broader shift toward long-term strategic reassessment. Investors are evaluating operational efficiency, automation, and productivity-driven companies as potential safe havens in a cooling valuation environment. Rather than chasing rapid gains, many are prioritizing recurring revenue models and durable competitive advantages. This shift reflects a desire for stability amid policy uncertainty and uneven sector performance. As a result, capital is flowing more selectively into firms with clearer paths to sustainable growth. 2. Inflation dynamics, softer data but limited market reaction. Paragraph 1. January's consumer price index rose 0.2%, slightly below expectations, bringing annualized inflation to 2.4%. While this represents progress toward the Federal Reserve's long-term target, markets showed little enthusiasm. The S&P 500 barely moved, and the Nasdaq slipped, indicating that investors may view the report as insufficient to shift policy expectations. The muted response suggests inflation improvements are now priced in, and traders want more consistent data before adjusting risk exposure. This dynamic reinforces the market's current data-sensitive posture. Paragraph 2. Cheaper gas and used cars contributed to easing price pressures, but core inflation remains sticky in several service categories. This mixed picture complicates the Fed's path forward, as policymakers must balance cooling headline inflation with persistent underlying pressures. Investors are watching closely for signals from upcoming Fed speeches and economic releases. The market's reaction indicates that inflation alone is no longer the dominant driver of sentiment. Instead, it is part of a broader mosaic of macro indicators. This shift reflects a more mature phase of the disinflation cycle. Paragraph 3. Institutional analysts emphasize that inflation's trajectory will continue to influence sector rotation patterns. Growth and tech stocks remain sensitive to rate expectations, while defensive sectors may benefit if inflation moderates further. However, without a clear policy pivot, markets are likely to remain range-bound. Investors are increasingly focused on operational fundamentals rather than macro speculation. This environment rewards disciplined, fundamentals-driven strategies over momentum chasing. 3. Federal Reserve Outlook, Policy Sensitivity at the Forefront. Paragraph 1. The Federal Reserve remains a central force shaping market behavior in early 2026. Recent speeches from Fed officials highlight ongoing concerns about inflation persistence, labor market dynamics, and the impact of AI on productivity. Policymakers are signaling a cautious approach, emphasizing data dependence and the need to avoid premature easing. This stance has reinforced investor expectations of a slower, more deliberate policy path. Markets are responding with heightened sensitivity to Fed communications. Paragraph 2. A key theme emerging from February's policy discussions is the Fed's focus on structural shifts in the economy. AI-driven productivity gains, evolving labor market patterns, and changes in consumer behavior are influencing the Fed's long-term outlook. These factors complicate traditional models used to forecast inflation and employment trends. As a result, policymakers are adopting a more flexible framework. Investors are adjusting their expectations accordingly, anticipating a more nuanced policy trajectory. Paragraph 3. The nomination of Kevin W. to a key policy role has added another layer of interest to the Fed's evolving stance. Institutional analysts are watching closely for how new leadership may influence regulatory priorities and monetary strategy. While no major shifts have been announced, markets remain alert to subtle changes in tone. This heightened attention underscores the Fed's outsized influence on market sentiment. In the current environment, even minor policy signals can trigger significant market reactions. For economic momentum, resilient consumer activity supports growth. Paragraph 1. Despite policy uncertainty, underlying economic data points to steady growth and resilient consumer activity. February's webcast from Hancock Whitney highlighted strong spending patterns and stable employment trends. These indicators suggest the economy retains momentum even as inflation cools. This resilience provides a buffer against potential market volatility. Investors are incorporating these signals into their long-term positioning. Paragraph 2. Consumer resilience is particularly notable given the mixed inflation environment. Lower energy and used car prices have supported household budgets, while wage growth continues to outpace inflation in several sectors. This combination has sustained demand across key industries. However, analysts caution that consumer strength may moderate if policy tightening persists. Markets are watching for signs of fatigue in discretionary spending. Paragraph 3. The broader economic picture suggests a transition phase rather than a turning point. Growth remains intact, but the pace is uneven across sectors. Investors are increasingly focused on identifying industries with structural tailwinds, such as automation, energy innovation, and digital infrastructure. These themes are shaping capital allocation strategies for both institutional and retail investors. The result is a more selective, fundamentals-driven market environment. 5. Sector rotation, tech sensitivity, and cyclical hesitation. Paragraph 1. Technology stocks continue to experience heightened volatility as investors reassess valuations in light of evolving rate expectations. Short bursts of momentum have been followed by sharp pullbacks, reflecting uncertainty about earnings durability. This pattern underscores tech's sensitivity to macro signals, particularly inflation and Fed commentary. Investors are increasingly differentiating between high-quality, cash-generating tech firms and speculative growth names. This selective approach is reshaping sector leadership. Paragraph 2. Cyclical sectors, meanwhile, are showing signs of hesitation. Despite improving inflation data, industries tied to economic cycles are struggling to gain traction. This reflects concerns about policy tightening and uneven consumer demand. Investors are adopting a wait-and-see approach, favoring defensive positioning over aggressive rotation. The result is a fragmented sector landscape with no clear leadership. Paragraph 3. Energy and industrials are emerging as potential bright spots, driven by innovation and long-term infrastructure trends. February's market analysis highlights several companies in these sectors making headlines for strategic pivots and operational improvements. These developments are attracting attention from investors seeking durable value. As markets remain volatile, sectors with structural tailwinds may outperform. This dynamic is shaping capital flows across the market. 6. Company movers, February's most watched stocks. Paragraph 1. February's market analysis identifies 10 companies driving headlines across sectors, from 52-week lows to energy innovation. These firms represent a cross-section of market sentiment, highlighting both challenges and opportunities in early 2026. Analysts emphasize transparency and fundamentals as key to navigating this environment. Investors are closely monitoring earnings updates, strategic pivots, and sector-specific catalysts. This focus reflects a broader shift toward fundamentals-driven investing. Paragraph 2. Several companies in the tech and consumer sectors are experiencing valuation resets as markets reassess growth expectations. This has created opportunities for long-term investors willing to look past short-term volatility. Meanwhile, energy and industrial firms are benefiting from innovation and infrastructure spending. These contrasting trends illustrate the market's fragmented nature. Investors are responding with selective positioning. Paragraph 3. The companies highlighted in February's analysis serve as a microcosm of broader market dynamics. Some are navigating operational challenges, while others are capitalizing on emerging opportunities. This diversity underscores the importance of company-specific research in a volatile environment. Investors are increasingly focused on identifying firms with durable competitive advantages. This approach aligns with the market's current fundamentals-driven posture. 7. Capital flows and institutional positioning. Paragraph 1. Institutional investors are adopting a more disciplined approach to capital allocation in early 2026. This shift reflects a desire to balance risk and opportunity amid policy uncertainty and uneven sector performance. Analysts highlight the importance of operational efficiency and recurring revenue models in attracting institutional capital. These themes are shaping portfolio construction across asset classes. Investors are prioritizing durability over momentum. Paragraph 2. Private equity firms are also becoming more selective, focusing on companies with strong fundamentals and clear paths to value creation. This disciplined approach reflects a broader trend toward quality over quantity in deal-making. Investors are increasingly wary of speculative valuations and are demanding greater transparency. This shift is reshaping the landscape for mergers and acquisitions. Capital is flowing toward firms with proven resilience. Paragraph 3. Institutional positioning is also being influenced by macro themes such as AI adoption, energy transition, and digital infrastructure. These structural trends are driving long-term investment strategies. Investors are seeking exposure to sectors with durable tailwinds and scalable growth potential. This approach reflects a desire to navigate volatility with a focus on long-term value. The result is a more strategic, fundamentals-driven capital allocation environment. 8. AI's impact on labor markets and financial strategy. Paragraph 1. AI continues to reshape labor markets and financial strategy, prompting policymakers and investors to reassess traditional models. Recent Fed discussions highlight the transformative potential of AI in productivity and workforce dynamics. These shifts have implications for inflation, wage growth, and long-term economic stability. Investors are watching closely for how AI adoption will influence corporate profitability. This theme is becoming increasingly central to market analysis. Paragraph 2. AI's impact extends beyond labor markets to financial operations and risk management. Companies are leveraging automation to improve efficiency and reduce operational costs. This trend is particularly pronounced in sectors such as banking, insurance, and asset management. Investors are evaluating which firms are best positioned to capitalize on AI-driven efficiencies. This analysis is shaping capital flows across the financial sector. Paragraph 3. The integration of AI into financial strategy also raises regulatory considerations. Policymakers are exploring how to balance innovation with oversight, particularly in areas such as algorithmic trading and credit risk assessment. These discussions are influencing market expectations for future regulation. Investors are monitoring these developments closely. The intersection of AI and finance is becoming a defining theme of early 2026. 9. Global market influences, China tech and international trends. Paragraph 1. Global markets continue to influence U.S. sentiment, particularly developments in China's technology sector. Investors are monitoring regulatory shifts, competitive dynamics, and innovation trends in key Chinese industries. These factors have implications for global supply chains and cross-border capital flows. The interplay between US and Chinese tech ecosystems remains a focal point for analysts. This dynamic is shaping international investment strategies. Paragraph 2. International trends in energy, infrastructure, and digital transformation are also influencing global markets. Investors are evaluating opportunities in emerging markets with strong growth potential. These themes are shaping global asset allocation strategies. Analysts emphasize the importance of diversification in navigating international volatility. This approach reflects a broader shift toward globalized investment frameworks. Paragraph 3. Global macro conditions, including inflation trends and policy decisions, continue to impact U.S. markets. Investors are monitoring central bank actions across major economies. These developments influence currency markets, commodity prices, and cross-border capital flows. The interconnected nature of global markets underscores the importance of international awareness. This theme is central to hybrid finance analysis. 10. Investor behavior, strategy shifts in a data-driven market. Paragraph 1. Investor behavior in early 2026 reflects a shift toward data-driven, fundamentals-focused strategies. Markets are increasingly sensitive to macro signals, earnings updates, and policy commentary. This environment rewards disciplined analysis over speculative positioning. Investors are prioritizing companies with strong operational fundamentals and recurring revenue models. This shift is reshaping market dynamics. Paragraph 2. Retail investors are also adapting to the new environment, focusing on long-term positioning rather than short-term trading. This trend reflects a growing awareness of market volatility and macro uncertainty. Analysts note that retail participation remains strong but more measured. This shift aligns with broader market trends toward fundamentals-driven investing. Retail behavior is becoming increasingly sophisticated. Paragraph 3. Institutional and retail investors alike are emphasizing risk management and strategic diversification. This approach reflects a desire to navigate volatility while capturing long-term opportunities. Investors are increasingly focused on sectors with structural tailwinds, such as automation, energy innovation, and digital infrastructure. These themes are shaping portfolio construction across the market. The result is a more strategic, disciplined investment environment. 7 subtopics, 1 paragraph each, 7 sentences. Subtopic 1: Soft inflation's impact on tech valuations. Soft inflation data has provided temporary relief for tech valuations, but investors remain cautious about long-term earnings durability. The sector's sensitivity to rate expectations continues to drive volatility. Analysts emphasize that valuation resets may create opportunities for selective long-term positioning. However, speculative growth names remain vulnerable to macro shifts. Investors are differentiating more sharply between high-quality and high-risk tech firms. This selective approach reflects a broader shift toward fundamentals. The sector's trajectory will depend heavily on future inflation readings. Subtopic 2: Energy innovation as a market stabilizer. Energy innovation is emerging as a stabilizing force in an otherwise volatile market environment. Companies investing in infrastructure and clean energy technologies are attracting institutional interest. These firms benefit from long-term structural tailwinds. Investors view energy innovation as a hedge against macro uncertainty. This trend is reshaping sector rotation patterns. Analysts highlight several companies making headlines for strategic pivots. Energy remains a key theme in February's market analysis. Subtopic 3: AI's influence on wage growth and productivity. AI adoption is influencing wage growth and productivity trends across multiple industries. Policymakers are monitoring these shifts closely. The Fed has highlighted AI's potential to reshape labor markets. Investors are evaluating how AI-driven efficiencies will impact corporate profitability. This theme is becoming central to macroeconomic analysis. Companies leveraging AI effectively may gain competitive advantages. These dynamics are shaping long-term investment strategies. Subtopic 4: Consumer resilience amid mixed inflation signals. Consumers continue to show resilience despite mixed inflation signals. Lower energy costs have supported household budgets. Wage growth remains strong in several sectors. This combination has sustained demand across key industries. Analysts caution that consumer strength may moderate if policy tightening persists. Markets are watching for signs of fatigue in discretionary spending. Consumer behavior remains a key driver of economic momentum. Subtopic 5: Institutional discipline in capital allocation. Institutional investors are adopting a more disciplined approach to capital allocation. This shift reflects a desire to balance risk and opportunity. Analysts emphasize the importance of operational efficiency and recurring revenue models. These themes are shaping portfolio construction. Investors are prioritizing durability over momentum. This disciplined approach is reshaping market dynamics. Capital is flowing toward firms with proven resilience. Subtopic 6: Global tech competition and market volatility. Global tech competition continues to influence market volatility. Developments in China's technology sector are particularly impactful. Investors are monitoring regulatory shifts and innovation trends. These factors have implications for global supply chains. The interplay between US and Chinese tech ecosystems remains a focal point. Analysts emphasize the importance of international awareness. This theme is central to hybrid finance analysis. Subtopic 7: Fed communication as a market catalyst. Fed communication remains a major catalyst for market movements. Investors are highly sensitive to policy signals. Recent speeches highlight concerns about inflation persistence and labor market dynamics. Policymakers emphasize data dependence. Finance News Update, February 15, 2026. Disclaimer: this is not legal, medical, financial, or official advice. The content below is general news reporting and entertainment only. Do not treat any of the following stories, data, or anecdotes as advice. Always consult qualified professionals for your personal decisions. U.S. equities, tech jitters dominate markets post-worst week of 2026. U.S. stocks ended a volatile week on a muted note Friday, February 13, as cooler-than-expected January inflation data provided some relief but failed to offset persistent fears of AI-driven disruption across white-collar industries. Dow Jones Industrial Average closed at 49,500.93, plus 48.95 points / plus 0.10%. S&P 500 closed at 6,836.17, plus 3.41 points / plus 0.05%. Nasdaq Composite closed at 22,546.67, minus 50.48 points / minus 0.22%. For the full week, all three major indexes recorded their largest declines of the year: Dow minus 1.2%, S&P 500 to 1.4%, Nasdaq minus 2.1%. The sell-off, initially concentrated in software and SaaS names, spread to wealth management, transportation, logistics, and networking hardware. Cisco Systems (CSCO) plunged 12% Thursday after issuing disappointing guidance, dragging the Dow lower. Analysts describe a clear rotation out of megacap technology into value stocks, small caps, and defensive sectors. Utilities and real estate outperformed Friday. The S&P 500 remains below the psychologically important 7,000 level after multiple failed attempts. Markets are closed Monday, February 16, for President's Day. Trading resumes Tuesday. Inflation and economic data. January CPI came in softer than expected, reinforcing bets for further Federal Reserve rate cuts later in 2026. Core measures also moderated, easing concerns that sticky services inflation would force the Fed to pause or even hike. The data helped stabilize Treasury yields, which declined across the curve on Friday. Broader economic signals remain mixed. Strong January jobs data contrasted with softening manufacturing and services PMIs, while consumer spending continues to hold up above inflation. Federal Reserve and monetary policy. The FOMC held the federal funds rate steady at 3.50% to 3.75% at its January meeting. Outgoing Chair Jerome Powell signaled that the current stance remains appropriate. President Trump's nominee to succeed